Casualty in the last 9 quarters or so because of inflationary worries. The clinker utilization levels in select clusters of Tamil Nadu, well, they are looking up as well. And the key beneficiaries would be Ramco. You'll have India Cement, Sagar, as well as Dalmia Bharat. Now, they continue to remain bullish on the cement space on the whole. Couple of factors that they have lined up here. In quarter two, they're working with 100 rupees per ton improvement in the EBITDA per ton. They say pricing has been positive in the past quarter. Input costs have cooled off as well. And risk reward is favorable. They have listed out their top stocks among large cap. They like Ultratech as well as Dalmia, and the mid-sized companies. They like Ramco as well as Nuvoca. That's why, in fact, all the stocks could be in focus.
Okay, interesting list. Keep your eye on cement names and counting down to the opening. 7 seconds left. After 4 days of losses, can the market stage a bit of a comeback today? The opening is likely to be absolutely flat. The first tick on the Nifty is in the green. We have opened around 19,700, a gain of 23 points. The sensex higher by 74, 75 points. So it's a flat opening, but with a positive bias, a gain of close to about 0.1%. Midcaps too have opened with some strength, up close to about 0.3%. The top gainer today is Bajaj Finance, 1.5%. At opening. This is ahead of a board meeting on the 5th of October where they will ponder some fundraising via a preferential or the QIP route. Other financials like Bajaj Finserv, Kotak Mahindra Bank have a green tick. State Bank of India, State Bank of India too, which is one of the big movers on Friday, is higher. You've got strength in pharma names like Cipla and Dr. Reddy's. Apollo Hospitals too has a green tick. On the losing side, softness seen in Hero MotoCorp, that's down 0.8%. IT is on the back foot. So Infosys, HCL Tech are under pressure. Remember, Accenture reports their numbers on Thursday. And that will truly give us an indication on whether there has been some pickup in the quarter gone by. So Accenture reporting numbers is often seen as a lead indicator for IT companies in terms of a demand trend. But given the fall that we've had on NASDAQ over the last couple of days, IT is a bit subdued in trade. Axis Bank is now selling off. In fact, the Nifty and the Sensex too have dipped into the red. First, it was up 25 points on the Nifty. Now we're down 23, 24 points on the Nifty.
All right, Rima, let's run you through some mid-cap names and two stocks that are getting hit very, very hard. Relicare, we had the news early this morning that the Burmans, they want a bigger chunk of the company, but the pricing was a disappointment. The stock closed at around 272 rupees. The open offers at around 235 rupees. That's one of the top stocks on the downside. Giving it company on the downside is Delta Corp because of the massive tax notice that they've got. The stock is down close to around 10%. It's locked in lower circuit, actually. Stocks that are moving with very, very high volumes include PNB Gilts. Remember, they have a high amount of exposure to bonds. And because of the inclusion of Indian bonds into the emerging market bond index, well, you could see bond prices could move favorably for them. And that's where the stock, after being up 20% in Friday's trading session, it opened up with a gain of 3%, but now it's flattened out more or less. Suzlon, that's another top volume mover. That as well is up close to around 3%. So, Prashant, more or less, those are the broad stocks that are moving on very, very high volumes. But the Nifty, well, that's moving lower. And now it's approaching that crucial support zone of around 19,600. What else?
Just a few other names. By the way, the market breadth is quite positive. Some almost a little over 2:1. 1,200 stocks are higher and about 600 stocks are lower. The top stock is Swan Energy, which is coming up with a 13% gain. But, it's also the top volume traded gainer. And that's the reason why I'm highlighting that Swan, not Suzlon, SWAN. So 336, 337 on that one is what you have. Big volume, by the way, 1.4 million shares off the bat. ITI, Mangalam was just pointing that out as a momentumizer name. 4% higher on that one, 198. Again, huge volumes. Again, 1.4 million shares on ITI at the word go. There is Nelcast, which is up 9%. So this is an unusual mix straight off, which is coming up with gains. Again, volumes are 1.3 million on Nelcast. Suzlon, we put that up earlier. It's up 3% as the fourth largest volume gainer. There is Tata Investment Corporation. So that's 2% higher. KNR Construction comes up with about a 4% gain right now. So that's at about 283. And what else? Electra Green Tech is up about 1.25, so small. Senco, we were highlighting that towards the fag end of last week. I think some initiations on Senco, but the stock this morning is up 5%, 524, the sort of predominantly East India-based jeweler. Gland Pharma, Bajaj Healthcare are some of the other names which are coming up with decent-sized gains on the back of volumes at this point in time. Berger Paints is down 4.5%. I'm not sure if there's any specific news flow, but Berger at about 640 and on the back of some decent sized volumes. So flows are there. GMR Power is down 3%. Religare we highlighted, Delta we highlighted. Maybe a JSW Energy, which is down 1.5%, and Nazara, which is down 2% as well, perhaps we put up. So that's largely the summary that we have. As I'm kind of commenting and picking out what's moving both up and down, market breadth is completely flattened, more or less now 1:1 from being 2:1. So 950 stocks are higher from 1,200. That's shrunk to 950 in 5 minutes, not even, actually a couple of minutes. And you've got 900 stocks which are lower. So that gap is just completely sort of narrowed and gone. The advances to declines 35 points lower, 19,640 is where we are on the index. Manishi Ray Chaudhary is with us, Asian equity strategist, equity cash Asia Pacific at BNP Paribas. Manishi, good to have you with us here. Thank you very much for your time. Are we beginning a bit of a global correction in your opinion? What is your global team's view?
That correction began some time ago. It coincided, and not surprisingly, with the US bond yields spiking. In this particular case, it was accompanied, somewhat surprisingly, with global energy prices, oil prices also going beyond 90, now approaching 95 to the barrel. And both these variables are actually, not quite helpful for Asian equities, particularly Indian equities. We have seen, consequently, the Asian currencies depreciating, and we think that this situation is likely to continue for some more time. So essentially, this is not really an India-specific phenomenon. If we are seeing it across emerging markets, whenever you have the US dollar appreciating, the US bond yields spiking, there's a flow of money in favor of the safe haven destinations like the US markets. And, I think this kind of a situation may continue for some more time. Now, having said this, India is in somewhat of a sweet spot, when it comes to protection that the market has because of domestic fund flows. This is something kind of unique to India. Almost no other emerging market has this advantage to the extent that India does. So I would think that the entire emerging market complex, the Asian markets, would possibly continue to have some correction. That said, the outperformance by India, even in that corrective phase, would likely continue.
Manishi, morning. Rima here. Just to labor on that point that you were making about the global markets getting into a tired sideways movement, as you call it in your report. You're saying this currently what we're seeing is similar to what happened in 2002, 2003. And at that time, the market declined. Then it drifted throughout Fed's rate cut period as concerns about a sharp economic slowdown became apparent. And the recovery started only after the Fed rate cuts were almost over, as the liquidity injected began seeping into the various financial assets. So are you saying we're in this grinding kind of period for a very long time, even as the Fed starts its rate cutting cycle? Perhaps sometime next year, markets are still not going to react positively?
I would think that this, tired sideways movement, which, very correctly quoted from my report, is likely to continue for, maybe another 3 quarters or so, maybe till the middle of 2024. We're in exactly that phase which we encountered, from mid 2002 to mid 2003, where the markets were directionless. The earnings estimates were, kind of coming down, but selectively, very selectively staying stable. And we're possibly in that kind of a situation right now. What would be necessitated to, sort of take the market out of here? We clearly need to come out of the recession narrative. And that narrative, unfortunately, is likely to continue until and unless the recession is actually over. And our global economics team thinks that that period would coincide with the first and second quarters of 2024, where we will have a shallow recession, but a recession nonetheless in the United States. Mid-2024 would also coincide with hopefully, the end of this higher for longer period. We think there could possibly be one more rate hike in November, but after that, there would be an extended period of higher for longer, maybe for another 3 quarters, and rate cuts would commence only in the second half of 2024. So when I put all this together, the macro variables would turn favorable for risk assets only in the second half of 2024. Until then, I'm afraid we may have to contend with this sideways movement.
Hi, Manishi. Manishi, what about HDFC Bank that's already been underperforming? It's not even sideways. It's actually down close to around 7%. And I think in the last
Right.
10 years, we haven't had a single year when HDFC Bank has given negative returns. And we just have
Right.
3 months to go. So hopefully it keeps, that record in terms of positive closes in a calendar year. You've liked private sector banks. Where does HDFC Bank feature in that list?
Right. So, I wouldn't obviously comment on, stock specific here. But in general, as you rightly point out, we do like the private sector banks in India. And we focus on those banks which are gaining market share. The entire gamut of private sector banks in India are gaining market share over the PSU banks. But even within that set, there are a few which are actually, for more adept at cost cutting because of better technology that they have. They're also gaining market share as a consequence of that better technology that they possess. And those are the banks that we're focusing on. So that, it's certainly, that's the story that would pan out, not just over the next 1 to 3 years, but even for much longer.
Right. Manishi, sorry, this, we're in a place where oil prices are up 30% from June, the dollar is higher, etc., which some of this you would discussed. But then on Friday, we got that global bond index news flow, right? So should we look at some of these, the two big global variables for India, dollar and oil, a little differently? It would still hurt, but maybe to a lesser degree. What's your sense?
I do tend to agree with that. If one looks at the global bond index inclusion, from the debt markets, we have the feedback that it would lead to anywhere between 25 to 30 billion inflow on the lower end of the estimate range, and possibly somewhere around 45 to 50 million on the billion rather on the higher end of the estimate range. So that's significant, and that inclusion is happening in June 2024, which would obviously have a salutary effect on the currency. Now that said, it's going to be a long drawn out affair. It'll basically pan out over the next 9 to 10 months, and before that, we will have to contend with higher fuel prices. We must also keep in mind that we're entering the winter season, where obviously there's a degree of pressure on the oil prices in the upward direction. So it's basically.
Oops.
Okay, I think we lost the line there. There was a freeze frame, but we'll just have Manishi back to complete that point. The index is now coming back into being absolutely flat. We were down about 20, 30 points. We're down 2.5, so absolutely flat now on the Nifty. Just take a look at the Nifty Bank as well, which outperformed what the Nifty did. The Nifty corrected on Friday, but Bank Nifty ended unchanged. It's already in the green, the Nifty Bank that is. Just to kind of go back and look at stocks, etc., Berger is the only significant kind of loser with about a 4.5% cut. There is, of course, the news-related ones, Religare and Delta. Religare, by the way, is also picked up. It was down 6.5%. Religare is now about just 2.5% lower at 264 or so. So, a fair bit of pickup from the low point of the day. Manishi, I believe, is back with us. Manishi, please, we lost you there. Go on.
Yeah. So I was talking about this bond index inclusion, and there's a significant degree of flows expected, possibly about 25 to 30 billion at the lower end of the estimate scale, 45 to 50 billion at the upper end of the estimate scale. So this is significant, no doubt, and it would support the currency. What we have to contend with is actually the near term. when oil prices would likely be likely continue to be firm. We are entering the winter season now. So I think, when it comes to this question of currency, there's a degree of difference between the near term and the longer term that investors would have to contend with.
Manishi, wanted your thoughts in on Indian industrials. In your portfolio, you do have holdings in L&T and BEL, so you are playing the Indian industrial space. The question is, how long do you think this government capex will continue? They've been spending massively, but can we assume this kind of government spending for the next 3 to 5 years? Are we closer to the end of this upcycle in industrials, or it's just gotten started and you would play it for the next 3-5 years?
We would definitely play the government capex theme, and therefore the consequent spilling over into private capex. We must remember that private capex hasn't really started in a big way yet. You rightly point out, and this is something we have been arguing as well, that if you look at government capex in infrastructure, in railways, in defense, all put together, capex as a proportion of total government spend has skyrocketed over the last 3 years. It used to be about 17% of total government expenditure. It has gone to about 25 to 27%. The only risk to this could be a spike in the fiscal deficit. Now, if I look at the tax collection that we're witnessing at this point of time, that doesn't seem to be a very potent threat at this point of time. So, looking at the government's intentions in terms of supporting capex and improving infrastructure, I would be willing to bet that this government capex would likely continue for over the next 2 to 3 years at least, and the spillover effect in the private capex would possibly accelerate. So yes, we are currently overweight. We have a significant allocation to Indian industrials in our model portfolio, and we see no reason to alter that.
Manishi, great conversation. Thank you very much for joining us this Monday morning. Let's move on and invite the management of Krishna Institute of Medical Sciences, KIMS as they call it. That's the next corporate on our radar today. Now, the stock has seen a stellar performance this year. It's up 50% in the last 6 months. The company recently made further investments in Kondapur Healthcare and has brought another 11.5% stake in Kondapur Healthcare, taking their overall stake to 28%. B. Bhaskara Rao, the managing director at KIMS, is now with us on the show. Mr. Rao, morning, and thank you very much for joining in. First, if you could talk about your investment in Kondapur Healthcare. You currently hold 28.8%. Do you want to increase your stake further so you have a controlling holding in this particular, in this investment? And the rationale behind it, what do you hope to get out of this investment?
The Kondapur, we have a listed company, has an existing subsidiary, 91% stake as of now. Now that is running around 90-92% occupancy. And there is a lot of scope for the KIMS to grow in that area, in that geography. That's why there was a big of 6 lakh square feet is coming. We are able to accommodate 600 beds in that space. Right now, what we have is only 200 beds. Now, in that, later on, we want to, once the entire building is ready, we would like to take it on a lease, a rental basis, and enable to run it for some time. Later date, we can able to see whether we can able to buy and merge into KIMS Kondapur, because these in 91% of KIMS, 9% is only the other doctors who are working in that entity is having that stake. So they love to have in the same area and to build the healthcare there in the geography. In that, that's why we have an opportunity to invest 28% of the stake, but over a period of time, maybe we can able to increase depending upon the requirement of the construction, both equity and debt, what they need. If there is any requirement, KIMS subsidiary would like to invest further. May not be for next till it will take about 25 March is the line that we have been put in, that the entire construction will be over. Till that time, we will be around less than 30-35%, unless it forces us to invest more if there is a need of either banks are not funding or anything. Otherwise,
Right.
we will
Mr. Rao,
stay as it is right now.
got it.
But we won't go into the majority of the stake in the next 2 to 3 years.
Okay, you can go
Once
up to
we shift
35%.
over there, and then we will decide whether it will be worth. So basically, we want to see a asset-light model in that area. And later on, once the capabilities is there, then we'll be able to work on that. Thank you.
Okay, Mr. Rao, good morning. So you have a hospital, a 200-bed hospital, which has been functioning, right, for the last many years.
Yes.
In that venture, you have 91%. This is a new hospital which is coming up in the same region, maybe close by.
Away.
Okay, so pretty much the same complex, almost contiguous. And in this you have 28%. You can go up to 35% by 25 if need be, is what you're saying. And once this is constructed, this is a greenfield project. How many beds will this have? And once this is completed, including any expansion at the existing 200-bed facility, how many beds will you have in Kondapur?
In Kondapur, once this is finished, it is a 600-bed hospital. So that will be a good size in the geography. Right now, we have only 200 beds. Most probably at that time, whether we are happy with that 600 beds, we may able to close the existing, which is a rental building, and then we will shift the entire thing towards the new facility.
Got it. All right.
We are not able to add few more specialities there because lack of beds. So those specialities we can add once we have a 600 beds there.
Got it. Okay. All right. Mr. Rao, I want to talk about a couple of other acquisitions that you did. And I'm looking at a brokerage note that's from IIFL. They're talking about the Sunshine acquisition that you've done in the recent past, as well as the Kingsway Hospital. Now, they've given some estimates. By 2026, they believe that on Sunshine, the EBITDA could go to around 200 crores. I think the last recorded number was around 85 crores. And, on the Nagpur Hospital, I think it was around 5-6 crores, or they believe it can go to 55 to 60 crores. You agree?
So what is happening is the Sunshine have two facilities. One in the Paradise, another one is the Gachibowli. The Paradise facility is pretty old facility where we could not able to attract good talent, and it is a rundown the facility. So we bought one more facility nearby to that existing facility, which we are going to on the way to shift to the new facility that got delayed about 1 or 2 quarters. Once that facility has been shifted, there is a new talent which are already identified. They are coming and joining, and then we are pretty confident that we can able to scale up to what we are achieving when we bought the Sunshine Hospital. We are 100% sure that we will be able to achieve. The Gachibowli is also a small facility, about 250 beds. We were able to operational efficiency made with the high-end cost of the doctors we are removed, and we are recruiting more and more talent. That is also, as we expected, it is keep going up. So we are pretty confident, maybe 1 or 2 quarters this way or that way, we will achieve what we are expecting to do that.
So what's the current capacity at KIMS? And once all this expansion comes on stream with your new investments in hospitals, etc., what would the bed capacity at KIMS be? Why your subsidiary and your investments?
Sorry, come again?
Mr. Rao wanted to understand what is the current capacity across, all the regions and hospitals, and once all this increased capacity, increased beds come on stream, whether it's in Gachibowli, Begumport, or even in Kondapur, what would the total beds at KIMS stand at?
So as of now, we have 4,000 beds. In next 2 to 3 years, we are going to increase up to nearly another 3,000 beds. Out of these 3,000 beds, nearly 1,200 beds are going to come in the existing facilities itself in Andhra and Telangana. Nearly 1,800 beds are coming from Maharashtra and Karnataka, maybe Tamil Nadu.
Okay. And sir, all this investment to increase your bed count by an additional 3,000, how will you be investing? What's the amount that KIMS will require to spend to increase this? And would you be open? Would you be interested? Do you think you will require some incremental funding coming through?
No, we don't require any incremental funding. Whatever is the internal accruals that we are getting, in the next 3 years, we may be having around nearly 1,500 crores of the cash that will come into the internal accruals. And another maybe 1,000 crores if we take it as a debt, that will be enough to fund all these 3,000 beds.
Right, Mr. Rao, so all of this, right, will come into fruition sometime in FY26. I mean, if one looks at your revenue growth, I think in FY23, actually, if you look at the EBITDA growth, that was about 19% in FY23. Could you tell us how this will shape up, say, not in 24, but 25? And I was looking at estimates by analysts who cover, your company. The kicker will come in FY26, I believe, if you can confirm that.
So 25 January onwards, we are expecting a few of the beds are going to functional, at least 600 beds in Andhra and Telangana, and maybe another 600, 700 beds in other states, Maharashtra and Bangalore. Maybe this is the one we are expecting by first quarter of 26, that is 25 January, maybe fourth quarter of 25th. And from there onwards, every 6 months, maybe we'll keep adding another 300 to 400 beds in every 6 months. That's how in 3 years period, we'll be able to add 3,000 beds.
3,000 bed. Okay, got that. Mr. Rao, we'll leave it there. Thank you very much for your time. Good speaking with you, sir. And appreciate you joining us here on CNBC-TV18. Thank you. We'll take a break here. We are back with Arun Maheshwari, Joint Managing Director and Chief Financial Officer at JSW Infrastructure. That's going to be a big IPO, which is opening today, 2,800 crore IPO. So interesting conversation lined up on the other side. Stay with us.
Welcome back. Well, 2023 has been a good year for IPO. So let's focus on one such IPO that's coming up. JSW Infra, well, their 2,800 crore IPO opens today for subscription. They've raised just around 1,260 crore rupees from a good list of anchor investors. The management, well, they're eyeing debt repayment of around 880 crores, though they also have some capex plans. So to understand more about the business, we're joined by Mr. Arun Maheshwari, the Joint Managing Director and the Chief Executive Officer at the company. Hi, Mr. Maheshwari. Good morning, and thanks so much for joining us here on CNBC-TV18. Well, one point that the street would like to understand is, out of your total cargo volumes, how much comes in from the group company? That's the JSW Group.
Well, as on June 23, the quarter ending June 23, it's about 63% comes from the group company.
Looking at reducing this...
37% comes from outside the group.
Are you looking at reducing this exposure?
Well, it has been... Yeah, it has been continuously reducing because, way back, the genesis of the company started way back to cater to the group captive cargo. Being a process-driven industry, if you see JSW Steel or JSW Energy, way back when we started in 2004, it was largely for the group captive supply chain management control. Till 2018, we were largely into the group company cargoes, and thereafter we started the focus on the third-party development. If you see very closely, 2019 onwards, majority of our investment has been on the third-party business development. It was as low as 6% in 2019 on a 35 million ton volume. In 2023, ending March, we did about 33% of the third-party volume on a 93 million tons of cargo. So the focus, the intention and investment has been very clearly defined how we are going to shape up this country as an independent vertical.
Got it. All right. Mr. Maheshwari, I just want to ask you and confirm this. You know, your margins with your larger listed peer is a little bit lower. You're in the mid-50s or thereabouts. They are in 60%, a little more than that. Is pricing at an arm's length with your group's companies? Or is there some kind of pricing difference? And do you expect margins to improve from here on?
Well, I would like to differentiate over here the business model, what we have taken for growth and for growing our business. We are largely, we are 50% into the greenfield ports capacity-wise and 50% from the terminal side. When we talk about terminal are the ports given on PPP model in the major ports, which are governed and controlled by the Government of India, wherein the ecosystem is provided by them. And we just pay a royalty against that ecosystem where capex is very low. So instead of looking at the EBITDA percentages, we generally go with the return on capital employed. And I think that's our guiding principle whenever we do an investment. So if you see our total building of capacity of 158 million ton, took a total capital of close to about 7,500 crore rupees, which is quite low as per the industry standard. And that's where because of the part of the EBITDA goes towards the royalty, but the return on capital employed remains very robust in this case.
Okay.
So what's the royalty amount?
It ranges from terminal to terminal. It is as low as 18% and is as high as 52%. But on an average, if I had to look at for our existing terminals, it is somewhere around close to 27%. And when it comes to arm's length pricing, as was asked earlier, I believe we are a well-governed company. Governance structure is very solid and very well in place for all the companies. So being a listed entity like JSW Steel and Energy, they go through a rigorous process. And since still we were not a listed company, we were behaving like a listed company. And we have been going through the similar process at our end as well. And if I have to give a very flair of, a greenfield port, typically a greenfield port in India makes about 60-65% kind of EBITDA margin. Our two greenfield ports are Dharamtar as well as Jaigarh Port, and they also make similar kind of EBITDA margins. So I think it clearly defines, how arm's length transactions are being handled within the group.
Mr. Maheshwari, hi, good morning. So the distinction is important, right?
Hi, good morning.
So basically, between terminals and ports, ports is high capex and high margins as well, as you said, 60-65%. Terminals is very asset light, but margins are on the lower side as well. And you said you look at return on capital employed as a better kind of metric there to assess profitability. Just a quick point, could you tell us, Mr. Maheshwari, what is the total capacity at? And what will it be? If you can, what will this grow to over the next couple of years? And just to try to get a sense of what's the visibility for additional capacity that the group will look at.
Well, if I had to look at today's capacity, it's about 158 million ton. This company is close to about 20-year-old company. And the CAGR on the volume side, if I had to look at it, it has been 22% over the last 20 years. Given the balance sheet what we have, given the appetite what we have, passion and the initiative what the group carries with them for all the verticals, and the opportunity what India offers today in this sector particularly, I think we will be able to try to maintain the similar kind of growth story. Even though the base is very high now, 158 million ton, but our intention is to remain very robust and keep growing on this sector, especially when the opportunities are unlimited over here. Very few players are there in this market today. And because it has a very high entry barrier, the capexes are very high in this sector. And you need a strong balance sheet, and we offer that. And you need to have a good intention to get into this business, and we do possess that.
So, the government is privatizing ports, it's putting up more and more port infrastructure out there for bidding, etc. So there's a large pipeline which will come up for bidding. So you're saying that, so what do you envisage JSW infra capacity to be, say, 5 years down the line? Where will you be at?
Oh yes, so the great opportunity which comes from the government terminals, because the government is inviting more and more private players to come mechanize, modernize the existing terminals, because government has done their job in the last 6-7 decades. They have done beautiful ports across the coastline. Now they are inviting people because government feels they should be going into the landlord model policy, and wherein they would be charging the royalty for the infrastructure what they have created, for the ecosystem what they have created. Now, people like us who hold quite a number of terminals in India, we are one of the largest in India on holding the terminals. We understand this business better, and we feel that this is a better way to go ahead, wherein the risks are minimal, the infrastructure is provided by the government, part of the infrastructure, the ecosystem is very robust, the customer base is very defined over there. So it is a very good model to grow from here on. And I think we are well suited for that. The kind of terminals we are already holding, the kind of performance we have exhibited in our existing terminals, and the upcoming which are coming up. It is difficult to put a number on the future from the terminal side because it is a bidding process. You bid for the terminals to win it. You win it, you don't win it, it depends upon that. But then pipeline is superb. Like Government of India still owns about 1,400 million ton of total capacity in India, which is more or less 50% of India's capacity. Imagine that kind of capacity is coming up for bidding in even part of it comes for bidding in a couple of 5, 7, 10 years. How many players are there in India today for that?
Correct. Sure. So you're giving us that outlook. That is,
I think we will be able to make it good out of it. Yeah.
Yes, Mr. Maheshwari, we know that there's huge scope out there. That's the broad point that you're making for a business like yours. Final couple of questions before we let you go. One is, how have volumes shaped up in the first half of this year, if I compare it with last year, point number one. And also the group exposure has come down to 63%. Is that a targeted number that it comes down to further?
I'll take the second question first, looking at the group exposure. The way the group is growing, the kind of ambitions what JSW Steel or Cement or Power has, I think it will be very difficult to reduce significantly the group volume, even though we will continue to grow on the third-party volume. I think on a longer-term basis, it will remain 50-50 or 60-40 towards the group side. So I think that would be a robust number, even though however best we try. One good thing is that, for any port company, a solid anchor customer is required. What a better combination than that if your anchor customer is from your own group and which is growth-oriented. Nothing can be a better combination than that for any port company. Now, coming to the volume front, on the H1, we don't have the audited figure. H1 is yet to end now. But Q1, our numbers has been 25.42 million tons for this June 23, and which is close to about 10% growth quarter-on-quarter basis, if I had to look at it.
Sir, since your focus is on return of on capital employed, that ratio has been going up. In FY21, it was 8.1%. FY22, you increased it to 10.88%, and in FY23, it's a 19.49%. Can you increase your ROCE even higher from current levels? Can it go up to, say, 25% based on the business model?
See, ROCE is purely a function how the utilization is happening. So our utilization, like June 23 ending, was about 63%. March 23 year end was about 57%. Before that, it was 45% and 35% and on. So as the utilization goes up, the ROCE keeps improving, especially when the capex is already done and only the utilization is remaining for performance purpose. If I had to look at, assuming if the company doesn't want to do anything further and just want to retain with this existing asset of 158 million ton, ROCE will keep on increasing because the utilization will keep on going up. So, but given the balance sheet, given the appetite and given the opportunity in India, I don't think so we are going to stay here. We'll continue to invest and we'll continue to grow this business. So ROCE may get a bit tapered down when we go into the capex model. And when the capexes are high, the ROCE will tend to go lower. But as with the utilization goes up, again, the ROCE will find its own ground.
Sir, do you have an aspiration in mind? You said the current capacity is 158 million tons. What would the number stand at 5 years down the line?
The way India is growing, I think putting any number to it would be a bit of a challenge as of now. But then I think our ambition is to, remain close to double the numbers in coming years, maybe 5, 7 years or 10 years kind of stuff.
Okay, well, 1,400 million ton capacity, let's assume 50% of it comes into the market for bidding next 5, 7 years. And there are,
huge.
as you said, you asked the question, how many players are there? There is, what, 2 or 3, right? You and Adani are the largest.
Yeah,
So,
maybe pan-India, see, whenever you see, there are regional players, but then pan-India players are very few.
Are few, yeah, absolutely. Good luck with that issue, sir. It's great speaking with you, and hope to speak with you again around the time of the listing. Thank you very much for joining us here on CNBC-TV18 with that perspective. That's JSW Infrastructure with the perspective on the issuance. Well, on to an exclusive conversation now. Latika Chopra, Executive Director of Consumer Research at JP Morgan, is now joining us on the sidelines of the conference they are holding, the India Investor Summit 2023. Latika, good to have you with us here. Thank you for waiting. You know, before we sort of get into specific sectors or sub-segments in terms of your coverage universe, broadly a comment on consumer demand, which seems to be, at least at the lower end, hurting by all indications. Just your assessment of it briefly before we go any further.
Yeah, sure. Thank you for inviting me for the show. So if I talk about the staples demand, clearly rural has been fairly painful, over much of the last 1 year. And if you look at the Nielsen data, the good news is that we've started to finally see some recovery settling in. After 5 quarters of negative volumes, finally we moved to the positive volume growth zone starting the June quarter. And when we speak to a lot of corporates as well, what we sense is that volume growth at the margin is improving. Of course, a lot of this growth is coming off a low base, but nevertheless, it's some improvement that's underway. And we hope, that this gradual recovery in rural is going to continue. And this is what our base case is also assuming. One of the bigger drivers for this improvement, in our view, is going to be moderating inflation. Product prices have stopped to inflate. Rather, in certain pockets, we are actually witnessing deflation, which is allowing consumers to come back and spend. And the other bit is that, FMCG companies themselves are upping the ante on advertising and promotions, further inducing, consumption demand to revive. So we're hopeful that the mass consumption will gradually, improve in the coming quarters. And what we're assuming for our staples pack is also that the volume growth, which is hovering in, flat to low single-digit zone right now, will gradually gravitate upward towards about mid-single-digit plus kind of range in the coming quarters.
Latika, you want to segment the consumer demand in the various categories for, say, FMCG, urban and rural, the paints, jewelry companies, because you do track a couple of these, large jewelry companies. Do you want to talk about consumer durables? Can you segment, the outlook and what you're picking up on the ground in terms of demand for each of those categories?
Sure. So I talked about the rural bit, but just coming to urban, and let me start with the FMCG bit. FMCG demand in urban has been holding out quite well, right? For much of the last year, it's been tracking well ahead of rural, though that gap is now narrowing given the recent uptick that we have seen in rural. But on the discretionary side, the urban discretionary demand has been quite soft. So, you look at QSR, you look at, consumer durables, you look at fashion. These are the segments which have been affected adversely, on account of higher inflation, impacting the disposable incomes. But at the same time, what we believe is that starting December quarter, there will be some green shoots that are going to emerge. One, the sectors are going to start lapping a low base. And two, of course, the moderating inflation will allow consumers to come out and spend. Now, if you look at the high-end consumption, and jewelry companies, since you mentioned, the organized jewelry players definitely are gaining, market shares from the informal market. Of course, there are a lot of initiatives from their end on product, on distribution, on very attractive offers to consumers, which are allowing them to grow well. And they also kind of target the higher-end consumer, which is probably less affected by the inflationary pressures. So jewelry demand has been good. Paints demand has held out really well, and there the B2B, the real estate, cycle improving. All of those factors have also benefited. Going into December quarter, also we will see the festive demand. This time the peak festive season is a little later, mid-October to mid-November. And we are hoping that this is good. And that's again going to, kind of support the discretionary demand in urban segments as well.
Latika, it's a strange kind of, in a way, dichotomy, right? You've got consumption, which is hurting, but government capex is pretty strong. The point is, if consumption does not pick up, there's no need for industries to put up new capacity, or at least expand significantly. On the other hand, one can argue and say that because all this infra spending is happening, that will create jobs and boost consumption spending. What's the view at JP Morgan? I mean, between I don't know if you and your infra analysts have that debate, but how do you think about this?
See, for the sectors that I cover, I think companies are here for the long run, right? So, the near term can be volatile. There can be ups and downs on consumption trends. But the broader story is that the Indian consumption story is all about penetration. And then, of course, in FMCG, we talk a lot about premiumization. And to drive penetration, yes, I think companies are adequately investing behind capacity additions, wherever there is a need to be. Over the years, we have seen FMCG companies bringing a lot of outsourced manufacturing in-house, and they have been investing in building large-scale, manufacturing units to tap into the whole growth potential. So we do not see dearth or, companies really stopping capex, at least for the sectors that we cover. Again, even in durables, we continue to see, companies investing behind adding more capacities, because the view is that medium to long-term growth is pretty much intact in India. India is all about longevity of growth. And the other bit which is interesting that's happening in the consumption space with the market leaders is they're very open to explore, new segments, right? So portfolio diversification is another theme which is at play, for most of the sectors that I cover, and companies are trying to build those medium long-term drivers. So I don't think companies in any way are pulling back on capex in our sector. Of course, they are prudent about how they spend so that return ratios stay intact. And of course, M&A is another aspect where we have seen companies willing to put up money, selectively.
Latika, out of time. Thank you very much for joining in. Enjoy your conference. And once again, thank you for joining in. Getting back to the markets, it's still absolutely flat. Keep your eye out on L&T. It's seen some buying from the day's low. Today, the large buyback comes to an end. It's a 10,000 crore buyback at a price of 3,200 crore. And today is the last day for that buyback. The stock is off from the session lows. Mitesh is back with us for a few calls. Mitesh, thoughts on the first 45 minutes of trade? And you want to give us some trading ideas?
So it's a very subdued kind of a market, and which is not bad. After the decline last week, I think not showing continuation means that there could be some space for a bounce back. Though to me, the texture is slightly on the weaker side, and I would still prefer selling on rallies. But I think there could be a pullback, which could see the Nifty try and attempt levels closer to about 19,750, 770 kind of a range. In the best case scenario, 19,850. So I think we'll explore some shorting over there. But till then, on the stock side, I have a buy on JK Tires. Keep a stop below levels of 280 here. Look for targets of roughly around 305 to about 308. And the other one is Asian Paints, which is a buy with a stop at about 32.90 and a target of 33.80 on the upside.
Okay, thank you very much for that.
Rima, by the way, Mitesh, if you just stay on, just look at these sugar stocks, Rima. I mean, 5%, 6% on Balrampur. They were not in the mix earlier at all, but Balrampur is up 6%, Renuka is up 4%, Dwarikesh is up 7%. It starts with one or two names and then it spreads. Usually it's a sector move when the sugar space starts to move up. So is today one of those days is the question. Any thoughts here? The sugar names, I think you have exposure already in your portfolio as well, Mitesh.
I do, and I think they're showing very good traction. And my sense is that I think these stocks will see good medium-term uptrend. So while they are up today, you would still want to buy them, and because you're looking at more further upsides happening. So, for example, Dwarikesh Sugar, again, it starts the disclaimer that I have it in my personal portfolio. It's a recommendation to our clients as well. I am looking at a positional target of roughly around 120, 122 to begin with, but good chance that the highest weekly closing of 140 could be tested. Balram Pushini, I think, had a negative week last time, but it was just a pullback and it's bounced back very strongly from the lower levels. And my sense is that I think, the stock is heading towards levels of 500 plus. So you're looking at least about 10-15% kind of a move happening in the next few weeks. So I'm very positive and buy any declines into these stocks.
Thank you for joining in. Before we slip into a break, here is a special announcement. Did you know that India's cancer burden has witnessed a sharp incline, with 70% of cancer cases being diagnosed at a very late stage? With a vision to reverse this pattern, News 18 Network, Federal Bank, Hormis Memorial Foundation and Tata Trust have come together for a special campaign, Sanjeevani United Against Cancer, dedicated to early cancer detection through regular screening. Watch Sanjeevani United Against Cancer at 8:50 p.m. tonight as we embark on a journey to save lives and promote a healthier future. Welcome back. Shifting our attention to commodities now. Manisha is here with us. Manisha, what are you looking at?
Nima, thank you so much for that. While the ferrous metals seem to be doing quite okay, the non-ferrous metals have seen a continuous decline. Over the last 1 week, we've seen copper, aluminum, nickel, all of those metals decline. And that's exactly how we've seen the Asian markets today open up as well. So the strength in US dollar, which is trading at a 6-month high, definitely has been a deterrent there. And then the markets are looking at the interest rate cycle, which might be higher for longer. That clearly has been bothering the space. You also are looking at Chinese demand demand uneven. Even as the month of August, the data has been slightly on the positive side, but the property sector is still weak, and we have seen concerning statements come in from there. Markets also are looking at inventories, which have continued to pile up, especially in the months of June, July, and August. September clearly has been on the same lines as well, and that has put pressure. Markets are looking at copper inventories actually gain up by nearly 50% in the month of September. When you look at the inventories from the month of July, we are up by 175%. So we are standing at 162,000 tons at this point in time, which is the highest copper inventories that you have seen since 2021. If you want to buy copper right now, it's cheaper by $64 a ton as versus in 3 months going forward, which is also a highest discount in case of copper cash since 1994. That tells you that currently the supplies are higher and demand not so strong, and that's weighing on as well. This is the inventory picture that we've seen in case of copper. We were standing at a deficit of 72,000 tons in June. July, this number has come down to 19,000. Markets do believe if this is the picture that continues, you could be looking at a break-even or even a smaller surplus coming in case of copper by the next quarter. It's not just copper. Nickel is trading at a 14-month lows. You have seen pressure continue for aluminum as well, which is trading at around 3-week lows as well. Here as well, the markets have seen inventories on the weaker side. Lead inventories, for example, are also trading at the highest since 2021. So markets are actually dealing with higher production from China. Europe seems to be picking up, and inventories on LME are higher because on-ground demand is slightly lower. This is the chart picture where we are looking at aluminum trading below 50 days moving average, above rather, but below 200 days moving average. So currently seems consolidating, but the near-term picture is still on the weaker side. And that's copper for you, which has seen constant decline. It's trading below 50 DMA and 200 days moving average as well. So on charts as well, there's not so much of bullish cues or enthusiasm coming in. This is what we've done on a week-on-week and a month-on-month basis for many of these metal prices. As you can see, on week-on-week, everything has seen a decline. Zinc, barring that, because that saw some gains coming in on Friday. But on a month-on-month basis as well, barring aluminum and zinc, we've seen more pressure come in for copper. So underperformance clearly coming in from Dr. Copper, as we call it. So that really tells you on where we are headed.
Okay, Manisha, thank you very much for that. Get into a break. On the other side is our special segment. It's The Economy, where Lata will get chatting with Shantanu Sengupta, Chief India Economist at Goldman Sachs, and Rajiv Radhakrishnan of SBI Mutual Fund about the impact of India's bonds getting included in the JP Morgan Emerging Market Index on passive and active money flowing into India.
Well, India's inclusion in the JP Morgan Global EM Bond Index saw yields fall on Friday, and then bonds gave up some gains. Now, over the weekend, experts have done their math on how much passive and active money will flow into India and what may be the impact on the economy. Joining me to analyze precisely that is Shantanu Sengupta, the economist at Goldman Sachs India, and Rajiv Radhakrishnan, the head of fixed income, head of debt at SBI Mutual Fund. Gentlemen, thank you very much indeed for joining me. Shantanu, to you first. What's the math at Goldman Sachs? How much are you all expecting in terms of flows?
Yeah, so we are estimating that the inclusion could prompt passive inflows of around $30 billion. This comprises of both EM local dedicated funds as well as the blended funds. This will be over the scaling period and as a one-off stock adjustment. Now, that's the passive part. Now, given India's attractiveness in terms of both carry, which is yields, and the low vol, both in rates as well as a low vol currency, we think that this could attract at least another $10 billion in terms of active flows through overweight positioning, off-win index flows from the crossover funds or total return funds, etc. So all of that put together, this could mean about $40 billion of inflows just from this over the next year and a half, where the phase-in period will be completed by March 25.
Okay. I read through your Asia report, and you all are not very confident that, I mean, FTSE, you say the inclusion is not possible because they want A+ in terms of sovereign rating, but you're more hopeful of Bloomberg Barclays inclusion. Rajiv, where do you all stand? Are you also agreeing to this $40 billion of inflows? And where do you stand on likely inclusion in the Bloomberg Barclays Index?
Yeah, on the first part, you have a range of estimates with respect to how much flows could potentially come into India post this announcement. Now, the range is anywhere between 24 to 40. But I think what one needs to understand here is the numbers are taken from the broader, the 10% weighting that India is likely to attain over the inclusion period and the overall indexed AUM at this point in time. But I think within that, we're not really sure to what extent we have pure tracker funds, which effectively will have to go with the index weighting, and to what extent are the active funds, which would have some benchmarking to this particular index. So it's very difficult at this point to hazard a real guess as to what would be the exact amount that would come in over this inclusion period. But I would still go with this range of 24-25 billion purely from the JP Morgan inclusion perspective. And on the other side, the other question was with respect to the FTSE index inclusion. So from what I understand, there are broadly two indices. One is the emerging market index, wherein I think there is a review which is due by end of this month. It's quite possible that you might get a positive announcement on that, but I don't think the index or the AUM that tracks that particular index is very large at this point. The larger one is the global aggregate index, wherein the sovereign rating becomes a constraint for India. So we will not get into that index at this point in time. But hopefully, if not in this review, maybe in the next review, FTSE might probably look at adding India in the EM index.
Bloomberg Barclays, I think that is the bigger one, Rajiv. That if we are included, and we should, I mean, in your house view, do you stand a chance there?
In the bigger one?
The Bloomberg Barclays Index.
Oh, yeah. Okay. That is possible. But we really don't have a view on that. Given that, from what we understand, the criteria is broadly similar, maybe this could happen.
Okay. But Shantanu, why are you all... You said that's not your base case in your note. Why? I mean, I thought people were expecting that inclusion.
No, so I think what we are saying is that the FTSE WGBI has the credit rating requirement, therefore that really at this stage it cannot be included. The main obstacles to India getting included in the global ag index is still market access operations, etc. Now, if GBIM has gone through, despite nothing having changed really on market access or operations because the FAR bonds were there last year as well. If that was to be included, then hypothetically we think that this could attract another $15-odd billion of flow. So if you go through it, then GBIM passive plus active plus Bloomberg Global Ag, in that blue sky scenario, you could get anywhere close to $50 to $60 billion of inflows over the course of the next year and a half.
Yeah, I guess the bulls are arguing that if the market access is okay for whatever, 216 billion or thereabouts of passive funds tracking the JPM indexes, why would that market access not satisfy Bloomberg Barclays? Okay, maybe we should get Barclays themselves to speak about this. But Rajiv, now for the wheels on the ground, what are you all expecting in the quarter that's just coming up, October-December quarter? And what are you expecting in terms of the 10-year for the next 4 quarters, calendar 24?
Right. So if it's in terms of the flows that could come in, it's very difficult to sort of estimate at this point whether, when we look at over the last 5-6 months or maybe calendar year to date, we've already seen a reasonable amount of flows that have come into the FAR securities. I think that's the reason why, and to an extent, it was there in the price. So our yields have not reacted adversely to a lot of adverse external developments, and we've been held up in a broad range. I think when you get into the second half, one significant change that we will see compared to the first half would be the net supply, right? Compared to what the market had to absorb in H1, the total amount of net bond supply, the government security issuance that the market needs to absorb is substantially lower. So to that extent, I think that should provide a broad supportive range for the benchmark. But I think we need to see it in context of where the other macro parameters are.
No, give me a range. Give me a range. Give me a number that you're currently working with.
Are you talking on the benchmark?
Yes, benchmark, 10-year.
Yeah, so I would say that in the near term, probably we would be in a 10-15 basis points range from where we are trading today. So we're not likely to see a large sell-off, given that there are these supporting
No, so what,
factors.
705 to 720? No, give me numbers. We wouldn't be able to. 705 to 720 in the upcoming quarter. And the fourth
probably
quarter?
Around, 730.
Fourth quarter, do we go below 7?
I don't see that happening.
Okay, so 7 would be your base case. Now, Santanu, I want the economic impact more from you. In the year to come, after all, this is a one-shot movement, as your note repeatedly says, it's a stock inclusion. Do you think that makes for better ability for the government to spend? I mean, you can dare to have a slightly higher, current 5.9 can be reduced to 5.7 and we can get away with it because we have a huge buying, and therefore is that positive on growth? Give me your impact on deficit and growth for calendar 24 or FY25.
Yeah, so we actually think that for this year, especially getting into the second half, you've had 2 shocks, right? One is the oil shock, 2 is the food shock. Both of them supply shocks. Clients have been worried that this will pass on into inflation. Our pushback has been that this getting into an election year will completely get absorbed on the fiscal balances. Hence, we are looking at about 40-50 basis points of expenditure reallocation at this stage required on food, oil, and rural transfers. Our base case right now is that the government, which has shown their commitment to fiscal consolidation, stick to around that 5.9% of GDP fiscal deficit. So absent that, you would have had expenditure higher by 40-50 basis points. We think that there's going to be a reallocation coming through in terms of expenditure such that they're able to spend more on transfer payments and subsidies and yet keep the fiscal deficit at 5.9% of GDP. In the current quarter, we are a little more bearish on growth. We think it'll be in the 5% kind of handle, given the weather-related shocks that you've seen. Next quarter, we think it's going to be better, going above 6% and then settling around that 6% kind of mark for the rest of the year. We haven't made any changes to growth forecasts because of the fiscal reallocation that we are estimating.
My question is a bit broader than that and a bit longer term. Maybe you all have not thought through this because I'm speaking about FY25. The fisc has a little more money to spend. The cost of capital is going to come down. It will probably come down for corporates as well. This is a big thing, some $50-60 billion coming in. So would you want to tinker with or at least give a positive bias to FY25 growth?
No, I think the question is whether the government really wants to have a higher fiscal deficit just because that supply will be passed in 1 year or not. Ultimately, remember the fiscal consolidation path is for the government to hit 4.5% of GDP over the next couple of years, which means that if you were not to consolidate next year and then go in for a very sharp consolidation the year after, you'll have a tremendous negative impulse on growth. So, any macro strategy would then suggest that you sort of taper your consolidation towards 4.5% spread over the period of time rather than concentrating all of that in 1 year. In terms of the incremental demand coming into the system, we think that is the space for RBI to be given up. So the RBI has been, let's say, buying bonds over the last 3 or 4 years. It'll probably be the time when they are giving up on their buying and FIIs come in, or if the investment cycle was to really pick up and banks found it better to go out in the loan market and make use of funds there, then that is where the foreigners FII inflows are offsetting, rather than thinking of this as an increase in fiscal deficit just because they have incremental demand.
No,
so
that's fair.
the way
fair point. That's a
fair
point, Shantanu. But if cost of capital is lower for corporates because they are ultimately benchmarked to sovereign, is not that a growth pep for the, at least 1 year FY25?
Yeah, absolutely. So, if you think about your saving investment identity and then funding the current account deficit over the medium term, this just makes it easier for you to fund the current account deficit because now domestic savings can be channelized better in the economy if you do have an investment cycle. But remember, even without the foreigners participating in the domestic bond market and the government having this kind of supply, 10-year bond yields have been in the region of 7/4 plus minus. So it's not like without the foreign inflow of capital, you had a booming cycle which required a lot of, and therefore the government was really crowding out your investment at this stage. If you want to grow faster, I think the point is this, that if you want to grow faster, this inflow of $40 billion will help you grow faster without getting into macro imbalances in terms of either the current account blowing up and then currency having to adjust, or your 10-year bond yield having to adjust because of lower demand.
Okay, maybe I kind of eloped with my enthusiasm. The point is that you can better finance fiscal deficit and current account deficit. Cost of capital falls a bit. I was wondering if all this is a magic for higher growth. But as you correctly point out, if there is growth, then this is better financed. But ultimately, growth will depend on how well demand shapes up. And for that, of course, inflows is not the point where we should be looking at. Thank you very much, Shantanu. Unfortunately, we couldn't get the last views from Rajiv. We lost connection with him. But this discussion will continue. Thank you very much for joining us. We will meet again when the Reserve Bank announces its policy. Wrap up on Bazaar on that note. Chartbusters up next.
Delta Corp slumps 15% after receiving GST demand notices worth nearly 17,000 crore rupees. The company terms the tax demand to be arbitrary and contrary to the law, says it will pursue legal action. A big block deal also sees a little over 6% equity change hands this morning. Bajaj Finance says its board will consider a fundraise on the 5th of October. Analysts estimate the quantum to be around $1 billion, which could lead to an equity dilution of about 2%. Religare dips over 3% after the Berman family, which currently owns about 21.5% stake in the company, makes an open offer to acquire up to 26% stake at about 235 rupees a share, a significant discount to the current market price. The stock off lows. Stride surges over 3%, now 6% higher ahead of its board meeting today to discuss a corporate restructuring program. They also secure a US FDA nod for a cardiac drug. Emami is the other stock, up around 1.5% after appointing Manish Gupta as the president of Sales and Consumer Care Division. Gupta has over 25 years' experience in the consumer space and was previously building Swiggy's FMCG distribution network.
Hello and welcome to Chartbusters. I'm Nigel D'Souza and Mangalam Malu is back as well from his vacation. Well, Mangalam, good to have you back. Hope you had a good time. Looking forward to the treat that you're going to be giving us later today. I believe you went to the Apple Store as well in the United States?
The Apple Store in the United States. That was a dream come true, to be very honest. Not so much for the price of the new phone that we bought, but it was a dream. But having said all of that, so much happened when I wasn't here in the markets. Come back and the markets are